Welcome to the deep dive. This week, well, the global financial scene felt like a bit of a battleground. We saw these geopolitical headwinds clashing, really, directly with the anticipation of central bank easing.
Yeah,
And the
exactly.
result, it was a really diverse set of market reactions, some regions pulling back, others surging, and Asia was, well, a mixed bag.
It really was a week where you had to look beneath the surface, to figure out what was actually driving things.
Mhm.
So our focus today is going to be pretty sharp. We'll dissect these global market shifts, region by region, pinpoint the critical takeaways from the last few days, and then, importantly, give you a clear roadmap for what to watch next week.
Trying to cut through the noise, basically.
Right, exactly. Forget the noise. We're here for the signal.
Okay, let's dive straight into the United States then. Shortened trading week, but it certainly didn't feel short on action. We saw this fascinating split in equity performance, didn't we?
We really did.
The big names, NASDAQ, S&P 500, the Dow, all finished the week in the red.
Right. The pressure was definitely on those large cap stocks.
Yeah.
But interestingly, if you looked at the smaller and mid-sized companies, the Russell 2000, the S&P Mid Cap 400, they actually managed to post gains.
Which is significant, yeah. What does that divergence tell you?
Well, it suggests investors were maybe reassessing where they see potential growth versus, the more immediate risks tied to those bigger tech names, for instance.
And speaking of tech, that was a key factor weighing on the large caps, wasn't it? Particularly semiconductors involved in AI like Nvidia, AMD, they took quite a hit.
They did, a significant hit.
What was the trigger there?
It seems the main driver was renewed talk from the U.S. about potentially more restrictions on chip exports to China.
Ah, okay.
That kind of news immediately injects uncertainty about future revenue, future growth for those companies. So the market reacts pretty quickly. It's a clear example of geopolitics hitting specific sectors hard.
Absolutely. And then Fed Chair Powell steps up, and his comments didn't exactly pour oil on troubled waters, did they?
No, his message was pretty cautious overall. He flagged the risk of tariffs pushing up inflation and slowing down growth. Not really the combination the market wanted to hear.
Not ideal.
And he firmly pushed back on any idea of imminent rate cuts. So that hawkish tilt definitely added to the pullback in the big indices.
Okay. Let's shift gears to another sector, housing. Still looks weak.
Yeah, continued weakness there. The NAHB Sentiment Index, which measures home builder confidence, it stayed low, down at 40.
40.
And housing starts fell sharply in March, over 11%.
Wow. What's the core problem? Still affordability?
Fundamentally, yes.
Yeah.
It boils down to affordability challenges. I mean, D.R. Horton, a major builder, actually cut their financial outlook for next year.
Really?
Yeah, specifically citing these affordability pressures. So that really tells you how much strain higher rates and costs are putting on that market.
Right. But then contrast that with this surprise. Retail sales absolutely surged in March. Best monthly gain in 2 years, I think.
Yeah, huge jump, 1.4%.
That seems completely at odds with the housing picture. How do we square that?
It does seem contradictory, yeah. One possible explanation, and it's pretty compelling, is that consumers might be front-loading purchases.
Ah, buying ahead of tariffs.
Exactly. Anticipating potential price hikes from tariffs, maybe deciding to buy big-ticket items like cars now rather than later. It could be a case of pulling spending forward.
That makes sense. Okay, what about bonds and the dollar? Treasury yields dipped midweek after Powell, right? Gave treasuries a bit of a boost.
They did, yeah. Some flight to safety there, maybe. But the dollar, well, it continued its slide, hit a 3-year low, actually. It's down over 8% year to date.
So much for the safe haven appeal. What's chipping away at that?
Well, in this kind of global environment, you've got uncertainty, sure, but you also have other major economies, like in Europe, showing maybe more momentum or at least starting to ease policy.
Right.
So if investors see better growth or return opportunities elsewhere, they're less likely to just pile into the dollar purely for safety. Its relative appeal diminishes.
Got it. And speaking of assets people turn to in uncertain times, gold just keeps going up, smashed through $3,300 an ounce, up 25% this year alone.
Incredible run, yeah, up 25% year to date.
Is that just about equity jitters and the weaker dollar?
That's certainly a huge part of it. Gold's the traditional hedge against stock market turbulence.
Yeah.
Right? And a store of value when currencies are looking shaky.
Mm-hmm.
So, yeah, the current environment is giving it some pretty strong tailwinds.
Okay, let's pivot across the Atlantic then. Europe, a very different story over there, it seems. Equities rallied quite strongly.
Absolutely. A big rebound. The Stoichk's X600 index was up significantly, almost 4%.
Wow.
And you saw impressive gains in the national benchmarks, too. Italy's FTSE MIB up nearly 5%, the UK's FTSE 100 up over 4.5%, Germany's DAX over 3%.
So what was lighting a fire under European stocks?
Primarily, the market really liked the signals coming from the European Central Bank, the ECB, and also maybe some relief from tariffs being postponed.
Right. So what did the ECB actually do or say?
Well, the key move was cutting interest rates down to 2.25%.
Okay.
But maybe even more important was the forward guidance. They signaled more rate cuts are likely coming, and significantly, they dropped language suggesting policy was getting close to neutral.
Ah, so a clear dovish shift.
A very clear dovish shift, yeah. That surprised quite a few people, I think. Economists are now talking about rates potentially going below 1.5%.
So the prospect of cheaper money really boosted sentiment. What about the UK specifically? Its market was up strongly too.
Yeah, the UK definitely caught that positive European wave. But their own domestic data was a bit more mixed.
How so?
Well, on the one hand, inflation cooled more than forecast, down to 2.6%. That might give the Bank of England a bit more breathing room,
Oh, okay, that's positive.
But on the other hand, job losses mounted. Employment was down about 78,000 in March. And that's despite wage growth staying surprisingly strong, around 5.9%. So it's a tricky picture for the BBA. Inflation easing, but the labor market showing cracks alongside high wage growth.
Complex. Fascinating mix indeed. Okay, let's head east now. Japan, their markets also moved higher. What drove that?
Yeah, the Nikkei 225 was up over 2%. The broader two-piece up about 2.6%. The main driver there seemed to be optimism around trade talks between Japan and the U.S.
Ah, trade optimism again?
Seems so. That positive feeling seemed to outweigh the more cautious tone coming from the Bank of Japan itself. The yen strengthened slightly too, near 142 to the dollar.
And what was the BOJ's message? They've been pretty hesitant lately, right?
That's right. Governor Ueda basically signaled they're likely sticking to their cautious path. He suggested any further rate hikes might be delayed because of, external global risks.
Okay.
He really emphasized they're ready to keep policy supportive if needed, so no big rush to tighten things up aggressively.
We also got some trade data out of Japan. Didn't sound great.
Oh, it's pretty disappointing, actually. Export growth in March, just 3.9% year-on-year. That missed expectations by quite a bit, and it was a sharp slowdown from February. And while imports did get back into positive territory, growth there also missed forecasts. So it kind of points to maybe some weakening external demand, which isn't great news for their export-heavy economy.
Right. Okay, last stop, China. Modest gains on the mainland, Shanghai and the CSI 300, but Hong Kong did better?
Yeah, the Hang Seng in Hong Kong was up about 2.3% stronger than the mainland indices.
What was the story there? Stimulus hopes?
That seemed to be the main thing, yeah.
Yeah.
Ongoing expectations that Beijing will roll out more support measures for the economy. The market is clearly looking for more government action.
We did get their Q1 GDP numbers, which actually beat forecasts, but there was a catch, right?
Exactly. The headline number, 5.4% year-over-year growth, looked good on the surface.
Yeah.
But a lot of analysts attributed that to companies basically stockpiling goods before those higher U.S. tariffs kicked in.
Ah, the front-loading effect?
Precisely. So the expectation is we'll see more of a growth hit in the coming quarters as those tariffs rising to 145% in some cases really start to bite.
But didn't we also see some surprisingly decent March data? Industrial output, retail sales?
Yes, we did. Industrial output up 7.7%, retail sales up 5.9% year-over-year.
Both pretty strong.
Does that change the picture much?
Well, it might give Beijing a little bit of short-term breathing room.
Yeah.
Maybe delay the need for immediate massive stimulus. But the underlying concern about the impact of U.S. tariffs on longer-term growth hasn't really gone away. All eyes are on the upcoming Politburo meeting for signals on their next policy moves.
Okay, that's a fantastic run-through of the week that was. Now let's look ahead. Next week, April 21st to 25th. Starting in the U.S., what are the key data points?
Okay, U.S. Monday, we get the Conference Board's leading economic index. Wednesday brings new home sales data. Thursday's busy, durable goods orders, and the weekly jobless claims.
Right.
And then Friday, we wrap up with the University of Michigan Consumer Sentiment Index. Always an important read on the consumer mood.
Okay, what about Europe? For Europe, Wednesday has the Eurozone trade balance for February. Then Friday is packed. We get the Eurozone business confidence for April, Germany's very closely watched IFO business climate survey that includes expectations and current assessment for April.
The IFO is always key.
Always. And also on Friday, the Eurozone Producer Price Index, the PPI, for March, both month-on-month and year-on-year.
Got it. And Japan.
Japan. Tuesday has the final leading index for February. Thursday sees the final figures for March machine tool orders, and Friday brings the Tokyo CPI for April, including the core reading excluding fresh food and energy, plus Tokyo department store sales.
Okay, and finally, China. Anything major next week?
Just one key release for China, but it's important. On Saturday, we get industrial profits for March. That will give us another clue about the health of their manufacturing sector.
Okay, so another packed week ahead. Lots of crucial data as these competing forces, trade tensions, central bank actions keep playing out globally. It's really clear from our discussion today that we're at a pretty pivotal moment, isn't it? Different regions are navigating these cross currents in quite distinct ways.
Absolutely. And while, we've tried to give a detailed snapshot today of the key moves and the drivers, it's crucial to remember this landscape is shifting constantly.
Oh, it's...
The interplay between trade policy and central bank responses, that's really going to dominate market sentiment and, frankly, economic outcomes for the foreseeable future.
So a final thought for our listeners then. As you digest all this complex dance between trade and monetary policy, what single factor do you think will be the biggest driver for markets in the coming months? And maybe more importantly, why? Something to chew on, thinking about how interconnected all these global forces really are. Thanks for taking the deep dive with us.